Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite studio in Times Square, New York City, we have Sam Weitzman, product specialist with Western Asset Management. We're going to discuss the municipal bond market and investors, what they need to know when investing in the space. Sam, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me.
We all know it was somewhat of a tough environment for fixed income. How has the muni market fared so far this year?
Yeah, the muni market certainly was challenged last year with the rest of fixed income down 8.5%. This year, we're starting to see a recovery as the Fed rate hike cycle the end comes in sight. And so far this year, we're up 3%, and we think there's room to run from here.
What do you think is driving that room to run, and what is Western's outlook of munis for the rest of the year?
Yeah, so we think there's two important factors driving munis in the back half of the year. First is overall starting yield levels, which are near decade highs, and second are improving supply and demand factors. From the overall starting yield level perspective, the Bloomberg Muni Bond Index is 3.5%. Again, near a decade high, and we think that's a generational income opportunity for taxpayers. If you're in the top tax bracket, that's nearly a 6% taxable equivalent yield just in the federal bracket. If you're in the state of New York, that's 8%. So those 6 to 8% taxable equivalent yields are certainly more than we're seeing in high-grade fixed income today.
Considering the Fed's aggressive hiking cycle, we're hearing more about concerns of a recession that is yet to materialize. What would that mean for muni allocations?
Yeah, so we pay a lot of attention to the credit cycle at Western Asset, and we don't forecast a sharp recession, but we are seeing a slowdown. We're seeing a slowdown in growth, we're seeing a slowdown in inflation, and that is translating to slower state and local revenues. But it is important to recognize that state and local credit, including those revenues, remain near their peaks. The muni market, from a credit perspective, performed really well during the pandemic. We've seen record high income tax collections driven by a favorable labor market. We've seen record high property tax collections driven by a favorable real estate market, and that kept taxes paid. And with those taxes that were paid, we saw the municipalities build up their cash balances for that rainy day. Rainy day balances are nearly 3 times the level that they were prior to the Great Recession or the Great Financial Crisis. And so should we get a recession, and that's not Western's base case, we think munis are in good shape to handle it.
Yeah, tell me about it. Tax assessments were a little bit shocking in 2021 and 2022, even this year. As a product specialist, where are you telling clients to look in the muni space?
Yeah, so we always try to learn about our clients' objectives and risk tolerances before making any recommendations. But what we like to highlight to clients at a high level is the muni market is extremely fragmented. You have 1 million QSIPs, 50,000 issuers. These securities don't trade on a daily basis. And with that, we see a lot of room for an active manager to operate and deliver value to clients, particularly when demand can outstrip the amount of supply available in our market. And one of the inefficiencies that we're seeing today is just the very high quality part of the municipal market, typically dominated by SMA investment. That's one of the key areas that we do see demand in today. And those guidelines are typically forced to invest at the highest grade part of the credit spectrum. So from a product development standpoint, we really try to be more flexible with our client guidelines, be able to access the lower investment grade part of the spectrum, particularly in these cycles where we are favorable on muni credit. And that flexibility, we think, will lead to longer term, better client outcomes for clients in the muni market.
So it sounds like this space is certainly for active management.
Absolutely.
For members of our audience who might not be as familiar with the muni space, besides looking for yield and looking for income, what are some of the tax advantages? Why do investors go to the muni space?
Yeah, so also for safety. When we look at an investment grade muni, it defaults as a fraction of the amount of the time as an investment grade corporate. A triple B muni actually defaults less than a single A corporate. So in terms of sleep at night money, you can find a lot of that safety in the muni market, and a lot of people are currently sleeping in their cash allocations today. And one of the things that we're emphasizing to our clients is that cash yield or your deposit yield might not be there forever when we think about the scope of projected Fed rates going forward. And the muni market is a great place to maintain some of that income that you're getting currently in cash yields, but do it in another high quality asset class like the muni market and lock in those yields for a longer period of time.
Are there different regions or states that are more safe than others?
Absolutely. You know, each with, as I noted, there's 50,000 obligors, right? And so you'll have different credits across the board, and that's why it's really important to have in-depth credit research staff that can look at any given credit, whether it's a state or a water and sewer issue or an electric utility. But each of those credits will depend on the underlying socioeconomic factors as well as the revenues that are securing that individual bond. So again, active management is needed to navigate those conditions.
All right, Sam, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.